Will November be the month everything explodes higher? Or will it be the moment the market shakes out everyone who isn't prepared? Right now, some of the strongest signals of a massive move are flashing across stocks, crypto, and the broader macro landscape. And one of the few analysts who actually called the last major cycle correctly, Tom Lee, is once again stepping forward with a message most investors are not ready to hear. He believes the super cycles are still intact, he sees November setting up for a breakout, and he's laying out a path that could take markets to levels that sound impossible until they happen. No, this isn't hopium. It's backed by hard data, 6 straight months of strength, an ISM that hasn't marked a market top once in 33 months, a setup where even a choppy start could still push the S&P 500 past 7,000, and underneath it all, a housing shortage and valuation gap so extreme that Nvidia looks cheaper than the biggest GDP growers in America. In this video, I'm going to break down Tom Lee's newest prediction, why he believes the risk-reward is still positive, and how November could become one of the most important months of this entire cycle.
You know, the super cycles are intact, so that's why we're not worried. There are walls of worry growing. That's what you're going to hear from folks, and those are going to give you chances to buy stocks. And thirdly, just keep in mind the risk reward's positive. So let's dive into this. You know, I'd say that we still think November's going to be an up month. I mean, with a lot of confidence. And the first reason for that is that stocks are up 6 months in a row, and it's almost going to strengthen the case for November to be positive.
For years, people have tried to call the top of this market. Every month, every pullback, every red candle becomes an excuse for fear. Yet here we are again with one of the clearest signals that the larger cycle is alive and powerful. When Tom Lee says the super cycles are intact, he is pointing to something most investors overlook. Markets climb through uncertainty. Markets rise when people hesitate. Markets push higher when the majority thinks the rally has gone too far. That is exactly why he highlights the walls of worry growing across the financial world. These are not red flags, they are opportunities for those who understand how money actually moves in an expanding cycle. 6 straight months of strength is not a fluke. It reflects a broader pattern where demand, liquidity, and earnings growth keep pressing forward even when sentiment feels shaky. When stocks deliver this kind of consistency, the following month historically carries momentum. That is why he expresses confidence that November leans positive. The structure of the trend supports it and the data reinforces it. Investors who fear every headline miss the larger picture that strength tends to follow strength. At the same time, large asset managers and institutions are sitting on massive amounts of cash. Over $5 trillion remains parked in money market funds. Historically, that kind of sideline capital does not stay inactive forever. The moment these institutions sense stability and upside, they rotate aggressively. A market that has already climbed for half a year becomes the magnet for that flow. This sets us up for something bigger. When a super cycle continues through hesitation, the next leg often accelerates faster than most expect. With that foundation in place, we can now look at why the broader upcycle remains far from finished.
You know, I think we're in a very different place. That was post depression period. We're really in the middle of an upcycle. And, you know, I still think we're going to be at least 7,000 by year end, maybe 7,300. And if you think it's late cycle, just keep in mind that ISM is still below 50, 33 months now. We've never been top of the market when the ISM is below 50. And keep in mind, housing is still undersupplied. We have built only 13.6 million homes in the past 10 years versus 15 million household formations. That's a shortage. That's the opposite of the GFC, when you had basically 7.5 million excess homes. And for those who think valuations are extended, keep in mind Nvidia is trading at only 29 times forward earnings. Costco's at 42.6 and Walmart's 35 times. It's still cheaper to buy Nvidia than to buy a GDP grower.
When Tom Lee says we are in a very different place, he is pointing directly at the misunderstanding most investors have right now. Many people are acting as if the market is approaching the end of a cycle when the data shows the opposite. The post-depression comparison some analysts use does not apply here. Instead, we are in the middle of an expansion where earnings, liquidity, and structural demand still have room to grow. That is why he confidently places the S&P 500 between 7,000 and 7,300 by year end. Targets like this are not emotional predictions, they come from observing the same indicators that have guided every major cycle in modern financial history. One of the strongest among those indicators is the ISM. For 33 months, it has remained below 50. Investors often see that as weakness, but historically it has never marked a top in the market. Markets do not peak when manufacturing is contracting. They peak when the ISM heats up, when growth is too strong, and when overheating risks rise. That is not today's environment. In fact, an ISM below 50 often acts as the coiled spring before a broader expansion. It sets the stage for a recovery that can push risk assets higher than skeptical traders expect. At the same time, liquidity conditions are shifting. The Federal Reserve has made it clear that rate cuts come once inflation stabilizes, and we are now seeing that stabilization across major components. Once cuts begin, capital becomes cheaper, earnings multiples expand, and equity valuations push upward. Historically, the 12 months following the first cut have been some of the strongest for broad indices. This paints a picture of a market not winding down but preparing to accelerate into its next phase. The belief that we are late in the cycle is the exact belief that fuels the next leg higher. With that clarity, the next part reveals how November's volatility could still resolve into a powerful upside move. And if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in.
But we know it's going to be choppy. We think it's a choppy first 2 weeks, but then we ultimately end up, over 200 points on the S&P. That would take us past 7,000. And these are the 6 years that I think are precedent markets. These are the times where the markets were up May through October. And you can see that the November to December, which is far on the far right, has been positive, except in 1936 when the markets basically were flat.
Tom Lee makes it clear that the early part of November may feel unstable, and that alone is enough to shake out traders who only look at short-term noise. A choppy environment creates doubt, and doubt leads many to pull back right before the move they were waiting for. But inside that turbulence is a setup he believes will push the S&P 500 more than 200 points higher, taking it through the 7,000 level. This type of pattern has shown up before, and every time the market came out stronger on the other side. The years he highlights are periods when markets posted gains from May all the way through October, a rare show of strength that only appears when liquidity and institutional participation are rising. In those historical cases, November and December delivered follow-through. The only exception was 1936, a year defined by an extreme policy shift and an economy still emerging from the Great Depression. Nothing in today's environment mirrors that backdrop. Instead, we are dealing with steady earnings, resilient consumer spending, and a corporate sector still investing heavily in artificial intelligence, energy infrastructure, and supply chain upgrades. When markets rise for 6 straight months, large funds begin adjusting their positioning. Underweight managers are forced to buy, momentum funds increase exposure, pension funds rebalance toward outperforming sectors. All of this feeds into the positive side of volatility. Choppy weeks become the pressure building before a breakout move. This is why volatility early in the month should not be read as a warning, but as a signal that the market is shaking loose weak hands before setting a new level. A run past 7,000 is not just possible. It becomes likely once the early hesitation fades and the broader trend reasserts itself. With that momentum building, the next part focuses on a part of the economy that remains one of the strongest tailwinds pushing this cycle forward.
Margins are expanding, and I think it's very telling because earlier this year, you remember the consensus from the Fed was that someone has to pay for these tariffs, So inflation would go up and margins would get squeezed. But in the third quarter of this year, which is in the full force of tariffs, companies taking 67% of that hit, earnings grew faster than revenues. 7 out of 11 sectors had margins expanding.
One of the most overlooked forces driving this entire cycle is the deep structural shortage in United States housing. For a decade, the country has built only 13.6 million homes, yet household formations reached 15 million. That gap represents millions of families competing for limited supply, and supply pressure like this keeps demand resilient even when rates are elevated. Tom Lee points out that this is the opposite of what happened during the global financial crisis when America had more than 7 million excess homes. Today, the imbalance works in favor of stronger markets, stronger construction activity, and stronger consumer wealth effects. When housing stays firm, the broader economy keeps moving. What makes this even more powerful is the way valuations have shifted. Many investors still think stocks are overpriced, but the numbers disagree. Nvidia trades at 29 times forward earnings, while Costco sits at more than 42 times and Walmart at 35. That means the company driving artificial intelligence adoption, powering data centers, and shaping the next decade of productivity is actually cheaper than two of America's most stable retailers. This gap tells you where growth is accumulating and where capital is likely to flow as institutions update their models. Artificial intelligence continues to expand into every corner of corporate America. Spending on chips, servers, cloud infrastructure, and automation remains one of the fastest growing categories across Fortune 500 companies. That is why earnings for the largest technology firms have resisted slowdown. Corporate America is not pulling back. They are doubling down on innovation, efficiency, and data-driven expansion. The companies that sit at the center of that transformation remain mispriced relative to their growth trajectories. Put all of this together and you see why housing strength and technology valuations form a foundation for higher markets. These are not signs of exhaustion, but signs of acceleration. Now that the core drivers are clear, let's expand the narrative and tie everything together into the broader opportunity forming for investors right now. With all four major signals lining up, the bigger picture becomes impossible to ignore. The market is not showing signs of exhaustion, it is showing signs of ignition. When you combine 6 straight months of strength, an ISM that has never marked a top, a choppy start that historically leads to upside, and a housing market built on real demand instead of speculation, you get the kind of setup that only appears a few times each decade. Most investors only see pieces of it. Very few connect all of it into a clear roadmap. That is where the real opportunity lives for anyone paying attention. Across the financial world, the largest pools of capital are preparing for rotation. Pension funds, sovereign wealth funds, major asset managers, and insurance providers all operate on allocation cycles. Once the Federal Reserve signals stability and liquidity flows normalize, those institutions are forced to rebalance into the strongest performing sectors. They cannot sit in cash. They cannot miss upside. They follow the trend because their mandates require it. And right now, the strongest trends sit in equities, artificial intelligence infrastructure, and digital assets positioned to benefit from increased liquidity. Every cycle shows the same pattern. Institutions arrive late but push the final legs higher. Another overlooked force is earnings momentum. Despite fear-driven narratives, corporate earnings have consistently surprised to the upside throughout the year. Companies are using technology, automation, and data to widen margins even in uncertain environments. That efficiency compounds when rates begin falling because lower capital costs magnify profitability. The combination of easing financial conditions and rising productivity has historically produced powerful multi-quarter rallies. Everything points to a market preparing for its next stage. Not a slowdown, not a reversal, but an acceleration into a new zone of strength. When cycles align this perfectly, the upside becomes larger than most expect, and the window to position narrows faster than people realize. With all of this in place, the opportunity forming in November is not just another move, it is a rare moment when the cycle, the data, and the psychology all point in one direction. Anyway guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.